I want to point to the U.S. 10-year yield right now, 2.5871. What kind of a move was this? Is it here to stay?
It's getting to be significant because we're at near the lows of the calendar year right now. After the Fed backed off in January from all of their rate hikes, one would have thought if the economy was doing okay that you would have saw higher yields, and we have not seen that yet. And so we're back down at the lows of the yield. The yield curve is the narrowest it's been to pretty much throughout this whole move. And I think it's telling a message that's a little bit different than the stock market, where the stock market is rallying and trying to break out on the idea that things are getting better. The bond market might be saying, hold on a minute here. They might not, we're not talking about recession here, but we're saying, they might not be as good as you think. So we're getting kind of mixed messages from the markets.
So how do you read this morning's high-frequency economic data then? Empire manufacturing, big disappointment. Industrial production, well, it was a disappointment, but, maybe not as bad as what it looked at first glance. Jolts were better than forecast, so much more labour turnover. And Michigan sentiment was better than forecast. What's going on in this economy, Jim?
Well, I think if you sum it up and you go back and remember that the tracking for Q1 GDP, either from the Atlanta Fed or the New York Federal Reserve, is pointing at a number of less than 1%, so a subpar quarter. And you've got more disappointments today than you had upside surprises. And that kind of fits with that the economy is just below average right now, kind of meandering along, at least in the first quarter. And there's few signs, at least right now, that it's getting ready to turn higher.
Jim, SocGen out with a note a little bit earlier on saying that the bund is likely going to go to zero. Do you just keep buying German debt at this point in time?
Well, it's not that far away from it right now. It's only a handful of basis points away. It wouldn't be surprising if it went through zero because it's done that before. The amount of negative yielding debt in Europe is rising. I think we're up to about $11 trillion again right now in it. But yeah, I think as the economy in Europe slows, Italy's in recession, the German economy is looking recession-y, I think yields will continue down, and I don't think zero will provide any kind of impediment, and they'll just keep going right through it.